Hello and welcome to Fed Tax 101. Today, we're going to begin a two-part discussion of the federal tax rules that apply to companies engaged in international commerce. In this first episode, we'll discuss the basic building blocks forming the foundation of the Internal Revenue Code's approach to international tax. Part 2 will build on this basic framework by focusing on four additional elements added by the tax reform legislation enacted in 2017: BEAT, GILTI, FDII, and the 100% dividends received deduction. But more on that later. Starting at square one, there essentially are two overall paradigms for taxing cross-border transactions. One, based on the source of the income, a territorial system, and the second, based on the residence of the company earning the income, a worldwide system. In general, a territorial system taxes income in the country in which it's earned. For example, if a British company makes a sale in London, the UK will tax that sale because it is UK sourced income. On the other hand, if the same British company sells the same product in another country, the UK would not tax that sale under its territorial system. Traditionally, in taxing US-based companies, the US tax code has used the second model, a worldwide system. Under a worldwide system, the IRS taxes an American company on any sale it makes, regardless of whether that sale occurs in the United States or in another country. On the other hand, the U.S. uses what basically is a territorial system for non-U.S. companies doing business here. If our British company, for example, is doing enough business in New York to have a sufficient nexus with the U.S., we'll tax that company on whatever it earns in the United States. How we tax a non-U.S. company's U.S. source income depends upon the type of income it is. So, the U.S. basically has sort of a hybrid system: a worldwide system for U.S. companies and a territorial system for foreign companies doing business here. Obviously, things get complicated when you're dealing with a global economy, with most of our trading partners using a territorial system, but the US using a worldwide system for US-based companies. You can pretty easily end up with some sales getting taxed twice, double taxation. For example, a US company manufactures a product in the US and sells it at one of its company-owned stores in London. The US will try to tax the sale proceeds because the seller is a U.S. company. But the UK also wants to tax the sale under its territorial system because the sale occurred there. But obviously, the company should not be taxed twice on the same sale. The U.S. tries to avoid double taxation in a couple of ways. First, we have income tax treaties with a number of our trading partners, under which we agree on how specific types of transactions are going to be taxed in our respective countries. These treaties aim to make sure that one of us, but only one of us, imposes an income tax on the transaction. Second, the U.S. tax code may allow you to claim a tax credit for taxes you pay to other countries, a foreign tax credit. The foreign tax credit rules require a separate, much more detailed discussion, but essentially you compute how much of your total U.S. tax liability for this year is the result of foreign source income that was taxed by another country. That ratio is used to compute the limit for how much you may be able to offset this year's U.S. tax liability by taxes you paid to a foreign government. That limitation helps eliminate potential double taxation resulting from income you earn outside the U.S. without affecting the tax you owe on your U.S. source income. Let's add one additional wrinkle. If your company has a branch in a foreign country It's conducting business there directly. It's the same company with one or more of its own stores or factories producing income in the foreign country. Those amounts would be part of the U.S. company's own worldwide income, so would be taxable in the U.S. in the year earned. On the other hand, the U.S. business could operate the same stores or factories in that same foreign country indirectly by forming a separate business entity under the laws of the foreign jurisdiction. That foreign subsidiary, a controlled foreign corporation or CFC, is legally distinct from the U.S. parent. So, unless that subsidiary itself does business directly in the U.S., the controlled foreign corporation's income is not subject to U.S. tax. Instead, the U.S. can tax those earnings only if and when they're paid to the U.S. parent as a dividend. And then, the IRS would be taxing the U.S. shareholder on its receipt of a dividend, not the foreign corporation on its sales income. If the U.S. parent doesn't want to pay U.S. tax on income it earns indirectly in the foreign country, the CFC simply doesn't declare a dividend and instead keeps its earnings offshore. By definition, the U.S. parent controls the CFC, meaning it has total control over whether and when the CFC's earnings come to the U.S. and become subject to U.S. taxation. This deferral of U.S. tax could last years, decades, or even permanently. Keep in mind, though, that this doesn't mean the U.S. parent isn't able to benefit from the CFC's earnings. Because money is fungible, the U.S. parent can just fund its foreign business activities indirectly using the CFC's offshore earnings and use its U.S. sourced and taxed income to fund its U.S. operations and investments. As with everything we discussed today, though, it can't be quite that simple. Under various anti-deferral rules, specific types of income that the CFC earns are subject to immediate taxation by the U.S. even if they remain offshore. This can occur if the CFC's income falls into specific categories of passive or highly mobile income. For example, the U.S. shareholder has to pay tax this year on Subpart F income earned by the CFC, even if it hasn't been paid to the parent as a dividend. With various exceptions, Subpart F income generally is passive income and other income that is easily moved from one jurisdiction to another. Things like dividends, interest, insurance income, and various other things. The United States had been criticized for quite a few years for sticking with a worldwide system of taxing cross-border transactions, especially since nearly all of our large trading partners use a territorial system. Many U.S. companies felt the U.S. tax rules, including our relatively high corporate tax rate, placed them at a competitive disadvantage globally. As a result, some U.S. companies started moving their global headquarters to other countries to avoid having their entire worldwide income taxed by the U.S. at tax rates higher than those imposed by many of our trading partners. For example, a large U.S. company would merge with a compatible company in Ireland, with the new company having its headquarters in Dublin rather than in Los Angeles, even though the U.S. business still has the same offices, employees, stores, and factories in California that it had before moving to Dublin. It technically is now part of an Irish company rather than a separate U.S. one. As a result, the company no longer has to pay the relatively high U.S. tax rate on its entire worldwide income. Instead, it would pay tax at those higher rates only on its U.S. source income, as other foreign-based companies do, with its foreign source income now beyond the reach of the IRS. This sort of inversion was intended to substantially reduce the company's overall tax burden without really affecting its business operations. So that's the basic framework for the tax code's approach to international tax. In part two, we'll discuss important new elements added by 2017 tax reform legislation: GILTI, FDII, BEAT, and the 100% dividends received deduction. Those concepts are essential pieces to the international tax puzzle and completing the story we began today. Well, that's it for this episode of Fed Tax 101. Keep checking back for more. So long, everyone.